Hey guys, welcome back. We've got a special edition of not really a snackable, not really a podcast. We're going over the Paperstac 2020 market report where we dive in and we brought two individuals on. We're diving in looking at all the mortgage note sales data collected from Paperstac. Super excited today.
Yeah, it's been a while compiling. It's something we've been working on for a while, and one of those times of the year where we super excited to put it out. This is the first time we've done a full year in the evaluations. We've done a mid-year before, first time for the entire year, and this is an interesting year for sure. Being all the numbers that have changed and fluctuated due to COVID and all the effects of that. Today we have two guests that we're welcoming. The first one, Jimmy Bateman, which is from Labrador Lending. He runs the podcast with Chris 70, which is the Good Deeds Note Investing podcast. You can find them at either one of those, or there's a Facebook group that they run as well, which is the Notes and Bolts Facebook group.
We'll put links to everything down below. You don't have to start scribbling away.
Nope. And then we also welcome Dan Deppen. Dan Deppen is from Fusion Notes. He's active in a lot of the Facebook groups as well. He has his own training platform called Systematic Due Diligence, and something else new coming out in the near future. So glad to have him. So let's welcome him on.
And let's jump right into the questions. I guess the first question, guys, thank you. Do any of the numbers from the 2020 report surprise you?
Overall, I wouldn't say they surprise me too much. I think it makes a lot of sense that you saw a slight dip in pricing as far as performing notes. So you see performing notes pricing looks very similar to 2019, a 3% drop it looks like. So I think because you had the 3-month gap in where there was really a stalemate between buyers and sellers, there wasn't a lot of activity there. Buyers who had a performing note at that time, sellers, who had a performing note, weren't willing to take on, they weren't willing to part ways with it because it was safe, the borrower's paying. And but given the risk of COVID, the pandemic, and everything that was related to that, sellers were certainly not looking to pay higher than they were in 2019. So that makes sense that it dropped slightly. And then the non-performers, if you've got some non-performing notes, it makes sense that would drop more than the performing notes did. Looks like 17% lower than the previous year. That makes sense to me that if you've got some non-performance and you don't know how long these forbearance moratoriums and eviction moratoriums are going to go on, you might want to just kind of cut bait and sell those at a discount. And then you move down to investment to value. That makes sense to me too, that these are significantly lower in 2020 numbers than compared to 2019 because property values just kept going up and up and up. So you've got 23% drop in pricing compared to for performing notes from 2020 compared to 2019 with investment to value. So that's taking into consideration the property values that just kept climbing. And then 30% for non-performing. So those numbers make a lot of sense to me.
Nothing that's a huge surprise. For me, the one thing that surprised me a little was the investment to value. Like I knew that was pretty favorable as, a lot more deals have had equity. But turns out there was actually a lot more equity, on average than I would have expected. So, to me, that explains, also some of the kind of price increases we've seen in the industry over the last year or two as well.
Good stuff. Good answers for the first question. All right. So on the second question, we have, how did the numbers on Paperstac compare to the transactions you were conducting off the platform?
They don't conduct off the platform. They don't do it off the platform.
I wish other platforms and other sellers put together a report like this. It's tough to compare. I would say that probably the other transactions I've done are in line with these numbers, I would guess, but it's hard to say for sure.
Yeah, for me, a lot of the numbers lined up pretty well as far as the pricing for first, 76% of UPB for performing and 65% for non-performing is pretty much in line with what I've seen. I always see different outliers sometimes, but on average, that's, pretty consistent with what I've seen. And for me, part of the reason why I've tended to buy more performing over the last year, because the spread between those two is fairly tight. So, for me, a lot of times I end up, may as well just buy the performing. So
Awesome. Good to hear. Yeah, I figured it should fall right in line with the marketplace. We have a large enough sample size that it should be pretty representative of what's going on in the market.
Very true.
The third question, what kind of predictions can you make about 2021 looking at the 2020 numbers?
I think, you're going to see overall greater activity in general. So maybe the numbers might actually have more weight. I think we saw a lot fewer. We had 3 months there where there was a major slowdown in activity. So I'm not sure how much weight we can put into the whole full 12 months. So I think 2021 will be more active, and the numbers themselves would probably be a little bit more reliable. Just in general, but as far as these numbers, I think we're going to see more of the same. I don't think we're going to see a drastic drop in pricing. You might see a little bit drop in pricing, where the gap that we saw in 2020 between the seller and buyer expectations, I think, will close. So you'll see sellers come down, I think, and see more activity because of that.
I think my prediction for 2021 is that the market's going to loosen up at some point. It seemed like throughout 2020, supply was fairly tight overall. Like some of the funds and things that I'm familiar with seem to be just seemed like a lot of people were just sort of hunkered down and not trading a lot. But I think already just in the last couple months, I've seen some instances where, funds have made moves and different things, and that's resulted in them, having assets that they're going to peel off and sell. And so I think my prediction is that people aren't going to stay hunkered down forever. At some point, we'll see more trading. Definitely, I think than we did in 2020.
Yeah, I agree. I think with what they were saying, I think that we will eventually see an uptick in trading volume. People are going to start liquidating some of their assets. So yeah, I think definitely I'm on the same page as they are.
Cool. And a last question. Do you believe COVID-19 has had a significant effect on the note investing industry?
Certainly. I think it remains to be seen. And I think, like I alluded to, there was a three-month period where there really just was not much activity. We're kind of just still waiting and seeing in that regard. I think we will see an influx of defaulted loans. I think 5% of loans are in some way distressed at this point, which is a high number. It's not where it was 10, 12 years ago, but I think as these moratoriums are lifted, both the eviction and foreclosure moratoria, I should say, and then states have their own legislation going on. As these things expire, we can't just, you'll see a flood. It won't be the massive flood that we saw 10, 12 years ago, but I think there will be an uptick in distressed assets available for note investors. When that happens exactly, who knows? It'll be nuanced. It'll be nuanced geographically. It'll be nuanced with the timing. It won't be all of a sudden in 1 week you see a massive influx. It'll be scattered, I think. But I do think in the next 1 to 2 years, we'll see an uptick in distressed assets. I don't see how that's avoidable. I mean, you can't just keep kicking the can down the road. So,
it's interesting. I surprisingly haven't really seen an effect on my performers. Borrowers hung in there. I thought when it first hit, there would be more effects in terms of the performance on my existing portfolio. Now, obviously, with the non-performers, with courts shut down at different times, it's drug out some timelines. And I think it's caused some buyers to be more skittish. And it seemed to cause some of the sellers to kind of hunker down. So I think that's why we saw less trading. So I've seen that impact. But as far as, borrower impact, everyone's just hung in there a lot better than I would have expected. So overall, I would say way fewer impacts than I thought when it started.
Yeah, we definitely saw the same sort of 3 month slowdown, that sort of dip, and then pricing started going, and certainly the volume started picking up and really exploding on Paperstac. So yeah, I think I agree. It definitely COVID-19 had a little bit of an influence on the market, certainly for that sort of end of Q2 or end of Q1, start of Q2 for 2-3 months, right up to the beginning of Q3. So I concur. So that was great, man. That was good stuff. Thank you guys for jumping in there again. If you want to learn more about the market report, you can click on the link below. We've got a link to the market report. You can look at the data, pour over the numbers yourself. If you have any comments, questions about the data that you'd like to put in there, and we'll get to them and answer them. We're happy to do that. We love the engagement on YouTube, on the platform. So please continue to do that. Helps us out. Lets us know what you're thinking and if what we're doing is of any value to you.
Very much so. Thank you so much for viewing the report, and we'll hope to see you in the next video.